it's all about the process. Like we have very detailed scorecards. Here's the property characteristics that you need to look for. Check, 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 score. So every analyst in our office has multiple screens where they've got scorecards, whether it's the industrial, retail, and even residential. Everyone's been trained to play from the same playbook. When you do that, you're able to source and execute efficiently. We will proactively identify the properties that we want. So we are not waiting for broker listings and then pursuing with the rest of the herd and being the highest bidder that wins it. For us, we don't think that's the way to generate outperformance for our investors. Over 80% of what we've done across the value add fund series have been sourced off market. Certainty, conviction, capital, competition, compression.
And then the 3 A's are?
Asset selection, adding value, and active management.
Love a framework. Love a framework. And I'm sure the people listening to this as well will be writing that down furiously. Jeff, welcome to the People Property Place podcast.
Thank you, Matthew. Appreciate you having me here.
Not at all. Well, look, it's a real privilege. I know London isn't your home, but you're over here and you've been on a kind of a roadshow across Europe. So I really appreciate you fitting us in here to talk a little bit about your background, experience, and CenterSquare as well.
My pleasure.
So if you're new to the show, welcome. My name is Matthew Watts. I'm the host of the People Property Place podcast, and I'm the founder of Rockborn, an executive search firm. And it gives me great pleasure that you are spending a little bit of time with us today. So Jeff, before we get into CenterSquare, can you just rewind the clock and just tell me a little bit about how and why you got into real estate in the first place?
Yeah, absolutely. I cannot say that, throughout high school, I said when I grow up, I want to be in real estate. I actually went to school to be a doctor. I was pre-med originally. Probably because my dad was a doctor, and he loved it. He had passion for it, and I respected what he did very much. But got to school, studied it, was good at it, didn't have that same passion. Took an economics class, then a finance class, and just found that much more interesting. So went on to a career in Wall Street to start. In New York, so it was great. Just a great place to go when you're young and hungry and surrounded by some of the smartest, hardest working people in the world. But even after doing that for a while, I wanted something more tangible. I wanted something that could take my, financial skills, people skills, and I liked doing the acquisition piece of the business, but I wanted it to be directed towards something that I could look at, see, touch, envision how you could transform and improve something. So I left New York, went back to Los Angeles, which is where I grew up. So I returned home to California to be closer to family and kind of relaunched the phase of my career. And that was in 2002. So worked with a small real estate operator just to get my hands, dirty. Drink from the fire hydrant, just throw myself in there and learned a lot from a whole bunch of people. And one of our partners was CenterSquare, actually on the investment side. And after working together, having a very successful investment, I was pulled over to really grow the presence in the Western U.S. Our company is headquartered in the East Coast in Philadelphia. And as you can imagine, real estate, it's important, to be close to the people, to the property, and to the places.
It's a local game.
On the ground. And so I helped open and grow our presence in the Western U.S. In lovely Newport Beach, California. So that's how I got here.
So did you have any family or kind of immediate contacts in the real estate game, or were they all in the kind of the medical world?
No, dad was a doctor, mom was a French teacher. So no contacts from a family perspective in real estate.
And then through your studies, it was kind of finance, economics, numbers, Wall Street. You kind of followed your curiosity, and specifically on Wall Street, what did you do, and which kind of sectors did you focus on?
So I was in corporate finance, so taking companies public and doing mergers and acquisitions. Started at Salomon Brothers, which obviously is no longer around, was a very well-regarded firm, and began my career there and focused on, and this is probably what planted the seeds for real estate to begin with, I was in the global consumer group. So working with retailers, department stores, drugstores, a whole bunch of, consumer goods type products. And thought it was really interesting. And one of the last projects I worked on was a large furniture company, stores all over the country, and furniture business was tough at the time. We were going to go sell it, and it was interesting because I had to build a model, and it was really store by store kind of performance model. And at the end of the day, what some of the feedback was, these are really good locations. The real estate may be worth more than the business, and so that was planted a seed in my head. But that I let it grow for a little bit. It got delayed. I ended up getting pulled over by one of the managing directors that I worked really closely with, right? Along the people theme, it's important to have good mentors, and I had a great mentor who, at Salomon, and I was there during the Salomon Smith Barney merger and Citigroup, et cetera, and he recruited me over to another investment bank startup to build the investment banking practice with him. So at that age, obviously a great entrepreneurial opportunity. So I jumped into the internet and .com and technology world for a few years. We know how that ended in the early 2000s. And then, as I kind of looked around and said, all right, this is why I want to do something that's tangible, take all the skills I've learned in finance and economics and kind of working with people on the investment banking side and translate that to kind of circling back to that, moment where I noticed, wow, this real estate is worth more than the business. I really want to get close to property.
Yeah, and it's physical. You can touch it, you can improve it.
Exactly.
And you can kind of see what it was like beforehand and then see what it was like afterwards. Then hopefully make some good financial return as well throughout that process.
In addition to the finance and economics and numbers, it comes back to I've got also a little bit of a creative side, and I like writing, I like dealing with people, and just having that kind of vision. And so that was the other thing I liked about real estate. Obviously, there's the financial components of it, but and the people components that we've talked about. But as you just mentioned, the ability to see something and have a vision. How can I improve this? Just what sort of renovation and scope and design? And it's just, I'm not great at just focusing on kind of one simple thing. I need to be challenged and be in a business that's dynamic. And that's what I love about real estate and what we do, right? You have the finance component, you have the people component, legal component. I mean, you're dealing with legal documents all day long as well. A little bit of marketing, right? Business development and things like this, which is great. And and then just that creativity and vision to be able to apply it to again a tangible property and see it come to reality. So it kind of gets all of those things fired up.
So you joined a small real estate business before you joined CenterSquare.
Yes.
What was the rationale with that? Was that just to kind of whet my appetite? I'm curious about this. Was that the only job you could get in terms of transferring the skills over, or?
No, good question. I looked at venture capital, private equity, kind of logical moves. A lot of investment bankers would then move to the more direct side, but again, that's companies still. And I talked to a whole bunch of real estate groups. The rationale was, specifically when you're making that transition, I didn't have direct real estate experience at that time. So I wanted to be a small and entrepreneurial, right? I started my career at the large bulge bracket investment bank. I took one entrepreneurial shot with a small startup investment bank, focused on technology. It was amazing, went public. I used to like to look at what my stock options were worth on a spreadsheet until they weren't during the tech wreck. So I was still relatively young and wanted something a little bit more entrepreneurial. And where I could just throw myself in and learn from doing, right? I mean, the other option was, I could go get my MBA and study real estate that way. I just felt that, the best path would be just throw yourself in there. I'll meet the people, I'll network, I'll learn the business by doing it. And so that's what I did. And I found a very entrepreneurial operator who just wanted to grow. And he really liked my Wall Street finance background. He had big dreams and all of that, and didn't have a financial model, so I built one for him. And it was great. It was for a few years. Worked really hard. We grew a lot. But at the end of the day, this was in the mid 2000s, and I kind of saw where things were heading and what was happening, and just where I was with my family. My young daughter had been born, and she was a 1 pound micro preemie, so super tiny, and it was just kind of a little bit hectic where I was, and I needed something more. I wanted to go back to institutional, stable, well-regarded, well-known. And that's how I ended up back at CenterSquare. And it really was the best of both worlds because, established company since 1987. So that was great, but also still in growth mode. It wasn't so big that, there was not going to be a lot of growth. So I saw a huge growth opportunity. And then candidly, helping open and spread our name in the West Coast, in the Western region, still, tickled that entrepreneurial spirit. I'm growing a business. We weren't as well known out in the Western US at the time. So I really enjoyed that. So it was sort of best of both worlds.
Yeah, kind of institutional backing, track record, credibility combined with the kind of more scrappy entrepreneurial startup, your name to kind of go and grow that part of the business and have that kind of ownership.
Yeah.
Given that you had quite a lot going on in your personal life as well. Yeah. So for people listening to this who don't know CenterSquare, you obviously touched on the fact it was set up in 1987. Yeah. can you give us a bit of an overview in terms of where the business is today and kind of what the strategies look like company-wide?
Yeah. So, I mean, starting 1987, I'll give you the history. It was focused on private real estate. So where I sit right now. And then we expanded in the mid 90s into the listed securities business. Our current CEO, Todd Burdell, actually started that business, coming back to the entrepreneurial spirit, right? We had a company that was in growth mode, and Todd saw this opportunity in listed securities and REITs. And the then CEO at the time said, "Okay, you're a very smart, hardworking guy. Let's see what we can do here." And we had some good clients that trusted us to start building a track record there, and went really well. And fast forward to today, the listed security side is actually a larger piece of our business and is global, and we have an amazing track record. So it's kind of another testament to the entrepreneurial nature of the business and the opportunities that we see. And then we've continued to grow. The private real estate, we started with just individual clients, mostly institutional capital, sort of working through a rotation system. And then in the early 2000s, we moved into the commingled fund, just as the speed of the business was moving quicker, and trying to go through a rotation system and get individual approvals.
Like deal by deal by deal. Yeah.
So commingled funds so that we could compete, which was great. We're actually now on our 6th value add fund. So we've been doing this for a while, and that's really where I spend most of my time. So I'm co-head of our private real estate group, really oversee our industrial and residential verticals, and we invest in those two sectors through the value add fund series, again, the closed end commingled funds, but also through separate accounts. So larger institutions who just want more of an income focused, we'll call it core plus, in those two sectors. And then also joint ventures where we're the direct operator and we'll have a joint venture with a large investor. So the ability to sort of approach, our high theme convictions in terms of the property types that we really like, multiple ways to invest in on behalf of our clients. And then, along the lines of the entrepreneurial nature of the business, again, my partner, the co-head of the private real estate group, Rob, we had an idea. We were trying to solve a challenge for one of our clients, right? It's just, how can we serve our clients? We had a large pension fund client that I was portfolio manager for, and they wanted safe distributable cash flow, right? All right, industrial, multifamily was perfect. Had some good secular tailwinds, good consistent cash flow, but the market got a little frothy, over the last cycle with interest rates dropping, and just the pricing, we really couldn't satisfy the return objective. So, the team put our heads together and said, okay, here's another opportunity in terms of small, consistent cash flow within retail. Unanchored strip centers, neighborhood convenience. We call it essential service retail. It's gotten a lot more popular now. Now you have a publicly traded REIT, but we were doing this 7-8+ years ago, again, to address a specific client's need. And then another client saw what we were doing and they liked it, and it grew. And my partner said, there's an opportunity here to grow this into a real business, an operating platform. Kind of saw the vision of more capital is going to be coming into this. It's been an unloved sector, painted with the broad brush, retail is bad because of what was going on, but there was a subsector here. Fast forward to today, over 70 properties. I mean, it's a very significant portfolio. We're one of the largest, operators of unanchored strip centers. So it's just, one of the things I love about this business and the platform of CenterSquare.
Am I right in saying you've also got a private credit business as well?
We do have a private credit business that's based in New York. And again, trying to provide solutions, especially right now. I think great opportunities with everything that's gone in the market with the reset of interest rates and folks needing that gap capital. So they'll provide mezzanine loans, preferred equity. What's going on in the multifamily sector right now is a great opportunity for them. So that's been a great business. And then we also have a strategic capital business that my partner Chad runs. And this is, again, another example of entrepreneurial that was born over the pandemic, where we saw opportunities to fill that white space between what we do on the private side, what we do in listed securities, and take advantage of where we have high conviction in certain themes. So think, more recently, let's go data centers, right? Or senior housing could be one, where we have high conviction, but they're very much operating business. You need the right management teams with the right relationships, the right experience. For me on the direct private side, investing in individual assets is a lot more challenging. We really want to stick to our niche subsectors that we do in residential and industrial, but being the largest independent global REIT manager, it's the opportunity for these private companies that eventually want to go public, they love having us as an investor. So it's more like traditional private equity. We invest in these platforms and management teams, growth capital, and the exit is eventually, go public or, get bought by a large private equity firm.
Yeah, it makes sense. It's kind of like owning that full ecosystem
Yes.
and that full structure. So in terms of going to investors, you can kind of offer them commingled funds, you can offer them separate account, clubs, JVs, access to direct investments, also private credit, and then kind of the more entrepreneurial strategic capital piece where you can kind of create a theme or a strategy and match that to capital, grow it, leveraging your listed experience as well.
Yeah, very well said. You just summarized the business and everything we're trying to accomplish in terms of being the preferred platform for investors, being able to provide real estate expertise across a variety of different channels.
And in terms of kind of office and global footprint, can you just share a bit of insight in terms of that?
Yeah, we, in terms of office investments, it was something that we saw again early. We sort of started moving away from office well before COVID. Obviously, we didn't see the pandemic coming. It was more of just, it was a very capital intensive property type. And just as, the need for creative office, modern office became, and your tenant improvement allowances, all of that capital you had to spend upfront into a property to make the individual suites, appeal to tenants at the time. Again, this is kind of more last cycle. We just didn't think you were getting paid for that risk of, again, putting all that capital up front before you as a means to having to secure a tenant. And compared to the other property types, at the time, residential, post global financial crisis, we saw that huge gap in housing supply, right? There was a shortage of housing, specifically entry level. So we saw that huge tailwind over, from 2008 for the next 5 years, there just wasn't a lot of supply being built. So we saw that as an opportunity in residential, so multifamily, and then specifically within BTR, SFR, we call it purpose-built rental communities, brand new homes, 3-bedroom, 4-bedroom product that is geared to be a surrogate for entry-level homes. So we saw that theme with a long, kind of tailwinds. And industrial, right? It was e-commerce was booming, the need to be closer to customers. We saw that happening. So we just saw long-term tailwinds and wanted to focus on that. We didn't see that, the secular tailwinds for office in any way, shape, or form. So that was really why we, began moving away from office. Across the last funds, it's, we were down to like one office in each fund. We're just moved away from office. So I think we only have 2 across the entire portfolio on the private side, office investments. So then those are long-term holds from a long time ago that will probably eventually be sold. So winding that down doesn't mean that there's not opportunity. Look, after a major dislocation like we've been through, there is an opportunity for investors to make money in office. It's very bifurcated right now. There are certain winners, but for us, we're just trying to stick to where we have high conviction and visibility into the long-term themes.
And in terms of those closed-ended funds, they're kind of 3-year investment cycles, kind of 7-year whold periods, and you're on your 6th one right now.
Yep, 6th fund.
And what's the kind of the raise or the target? How big? Give me an indication in terms of size and scale, and maybe over those different vintages. Yeah, I'm assuming they've gone up in size and scale each one as well.
A little bit. The very first one was roughly 280 million, but since then we've really targeted plus or minus $300 to $400 million funds. So our current fund 6, we're targeting a $400 million raise, not growing much bigger, and that's intentional. You get bigger and bigger. There's that pressure to deploy that capital. You become more and more just in line with the market, I think, the larger that you get. So we really want to be able to maintain our discipline, kind of be sharpshooters, be very selective. And we also play in the middle market. So we just see an opportunity, and by middle market, I'm talking transaction sizes in that $25 to $75 million total capitalization range. So if you just think about it, there's a lot more transactions, just the opportunity set, right? That pool is much larger than, if you need to go buy $200 million deals. There's only so many of them. And there's only so many platforms that have raised billions and millions of dollars that are going to be competing for that same opportunity set. So just in terms of being able to generate outperformance, we just see a better opportunity in that middle market where there's a mix of kind of owner sophistication levels. So that's why we stay in that size.
And you've been
range.
very disciplined with that, right from fund 1.
Yeah.
That's, because I talk to a lot of people and they start off with maybe a £200 million raise, and then the next one is 350, the next one's 700, and then the next is $1.5 billion. And as you kind of touched on, you have to kind of scale your business accordingly so there's not bottlenecks in terms of the deployment period. Yeah. It sounds like you've been very disciplined, and obviously there has been a little bit of creep, but that would be appropriate just given inflation and maybe the opportunity. But clearly through the cycles, you've been very disciplined in terms of what you're looking at.
And the key is what is the objective? What are we trying to deliver for our clients? And it's a value add strategy. So it's not a grow your AUM, assets under management, long-term hold kind of fee game. It's all about performance. So it means you acquire, you add your value, you execute your business plan, and then you sell and return capital to investors. That's within their whole portfolios. That's the where we fit in, is that from a value add fund perspective, total return. I want to invest the money, see that value creation, and get my capital returned as soon as possible. So that sale discipline is important, and it's just it's interesting as we kind of touched on the size of the funds and where we're focused and that opportunity. But over the last several years, we've actually gotten smaller in terms of the property types that we focus on. We kind of joke, small is mighty. Just taking that same theme. We talked about the unanchored strip retail. Those are smaller, obviously, transaction sizes. In industrial, also we've gone smaller. We're really very active in the large bulk distribution. Again, opportunity set, right? There's only so many large tenants that are going to go take down 300, 400, 500,000 square feet. We kind of saw the importance of infill, given what transportation costs and labor costs relative to a business's kind of cost structure. Like those were more important. You had more pricing power, and people didn't necessarily want to do these small deals because, coming back to our conversation, if you've got $1 billion fund, you're not going to go write $7-10 million equity checks. It's just not an efficient way to deploy. But that inefficiency for us is the opportunity. We think we get better pricing. We see more opportunity to create real value from who we're buying from by playing in that space. So we've actually also, we're not afraid to do the work. It's a lot more work to go find all of these small transactions, execute these plans, but that's how we're going to create scale, is by it's all about the process. Like we have very detailed scorecards, right? Because that's one thing. Well, how are you going to efficiently acquire all these smaller assets? If you have the process and you train the people to do it, you can do it very efficiently. So we have scorecards. We try and it takes out a lot of the subjectivity, right? It's just, here's the property characteristics that you need to look for. Check, 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 score. So every analyst, in our office has multiple screens where they've got scorecards, whether it's the industrial, retail, and even residential. And that's how we can everyone's been trained to play from the same playbook. Okay, here's the process. This is what we're looking for. We have the same sort of underwriting discipline. And when you do that, you're able to source and execute efficiently. We've got analysts who have sourced deals for us. That tells you about the power of the process.
And I guess also externally as well, to kind of brokers or advisors, you've got a very clear thesis, very clear message, and it just drives efficiency in terms of they know what deals to bring to you or to make you aware of. Does it take the CenterSquare buy box or not? We'll introduce it, but we're pretty confident in terms of that. Yeah. And I guess it's that repetition and that efficiency that drives a lot of the scale or ability to maybe beat off competitors to those particular deals.
Yeah, and that's a great point, Matthew, because brokers, they're hungry. What they need is clarity and clear direction. If they're just going to throw things at you, it just becomes frustrating for everyone. But I think what they appreciate is we give them a very clear, this is exactly what we're looking for, and we'll take it to the next level. We will proactively identify the properties that we want. So we are not waiting for broker listings and then pursuing with the rest of the herd and being the highest bidder that wins it. For us, we don't think that's the way to generate outperformance for our investors. Over 80% of what we've done across the value add fund series have been sourced off market, and that's because, to your point, we take not only the scorecards, but here are the properties specifically that we want to buy. You guys have direct relationships with some of these smaller private owners. If you can get us a rent roll, we'll get you an offer, and we're throwing in offers nonstop, and we know exactly what we want. And the brokers basically become our advocates, almost like an extension of the acquisition team, because either they have the direct properties to pursue on our behalf, or, to your point, they know even if we've somehow not captured something, they say, hey, we know this one, we've got your scorecard. It's easy and straightforward to follow. This is something that CenterSquare would like. So it is incredibly powerful and a great differentiator and advantage for us.
And in terms of the fund structure, I'm assuming, are you able to buy in cash so you can transact really quickly and then you kind of refinance or, structure it post-transaction so you can be super fast and super competitive in terms of your pricing?
Yeah, we certainly can. A lot of these things we're still able to get extended periods of due diligence, which is great. And again, compared to a listed transaction. If it's widely marketed, yes, you're then going to have to say not only be the highest bidder, but I'm going to have to do the shortest, due diligence period, shortest closing. We don't actually have to necessarily do that where we're playing. We can get longer due diligence periods, which means that usually we're able to line up debt at the same time. And we also have debt relationships. So usually we're able to close with financing in place and not have to take any kind of interim financing risk. But yes, we do have the ability, if we need to close really quickly, because we know we have a deep bench of lender relationships and we're doing the same thing, repeatable process, it's pretty straightforward. If it's an advantage for us to just close all cash, but usually, that financing, if we're doing that, we're already pretty far down a path with the lender. So we're not really taking huge exposure there.
So when you joined CenterSquare, did you set the kind of Newport Beach office up, or was there kind of already infrastructure there?
There was one gentleman out there who had just planted the flag. He was, again, along the people theme, my mentor, friend, he's like family. And he's the one who really trained me a lot for, in terms of process and procedures and what we're doing. So he was there and he brought me on board. He was very... he's retired now, so when I say was, he's retired. But I mean, one of the greatest kind of just bricks and sticks. He really understood real estate. The partnership was great because he wanted me to go out there with energy and go find these things. And so it was a great partnership. He taught me really everything about, real estate investing and assessing the bricks and sticks. And I was out there, going to find the transactions earlier in my career and developing relationships with, with owners, operators, et cetera, and brokers. So, that was how that came to be. And then he actually ended up moving to the East Coast, kind of early after a couple of years of me being with him, which was a great vote of confidence that he entrusted me to run the Western U.S. and then it took it from there.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. So your kind of role evolved from kind of underwriting, crunching, doing numbers, but also sourcing deals, and then through to kind of more of a leadership role over time and having more influence in terms of the strategy, and then also being a little bit more investor focused as well. Yeah.
So starting with our third value add fund, really and that team that's in place, kind of all the senior vice presidents, managing directors that are working, on the private side and in the fund have all been together since that period, since that Fund 3 period. So that's when I started getting involved from just the acquisition guy to more holistically, let's talk strategy, portfolio construction, et cetera. So that was Funds 3 and Fund 4. And then Fund 5, when my mentor started moving towards retirement, then I also added, I still do all the other things, but I added the investor-facing component as well. And now I get to spend a lot of time in it. But Fund 5 was also, kind of pandemic raise. So I was very investor focused, a lot of times through, computer screens. So there's a lot of video calls, et cetera. So I'm actually really happy that, the market, things have kind of evolved and now I'm back on the road talking to folks. So yeah, I spent a lot of my time meeting with investors but the beauty is I can do both, right? So I'm in any kind of city, I'm looking at potential acquisition targets that my team is sourcing, and then also meeting with investors. So I get to do both. Yeah, and I guess then you've got the leadership and the people component and that kind of pastoral piece in terms of their development and strategic oversight in terms of direction of the business, capital, and the types of deals you're doing as well. Yeah, which is great because, other things that I've benefited from CenterSquare is the people are just amazing. And I've had the privilege of working with a bunch of really smart, good people that have mentored me. And now I have the opportunity to sort of, pay it forward to this next generation. And that is something that's really important. And I think it's a key part of the culture of the firm is everyone, because again, as I mentioned, kind of the senior leadership now, we've been together for a long period of time. And we really look forward to sort of continuing to train and educate the next generation, because we've got some of our folks who are, business leaders started as interns and analysts. And so it's just, that kind of career growth and opportunity. I've been there for 20 years. You talk to a lot of people, how many people have been at one firm for an extended period of time. And we've got a whole bunch of folks who've had long careers at CenterSquare. So
What was the hardest kind of transition? Was it, doing the transactions and origination? Was it kind of moving to a leadership role and kind of man management, or was it kind of moving to being a little bit more investor facing, reporting, business development? Did you find one came a little bit easier than the other, or was it just natural evolution? And
There's similarities and overlaps to all, but I got into this business because I love real estate. I love the tangible bricks and sticks, the thrill of the hunt, going to find those opportunities, particularly for value add. What really wakes me up and keeps me motivated is, can I find that opportunity that other folks just don't see, right? Like there's a lot of, information out there in the public world. Everyone has the same information, right? So how do you really generate outperformance? And our team does an amazing job there. In the private world, there's a little bit more, lack of information transparency. So really being able to understand where is the right opportunity and then seeing it to fruition. I mean, when we would, buy something vacant, reposition, and then you look at the property, oh, wow, this turned out exactly the way I thought. Oh, and then you lease it really quickly, at rents that are higher than you underwrote, at costs that were less to get the tenant in. And then you sell it for a lower cap rate and you deliver this huge return. That adrenaline rush of I did this for my clients and I exceeded what I told them I was going to do. That is my favorite part of the business. So I would say, I'm a little bit further from the front lines because natural evolution. I've got, thankfully, an amazing team that I've worked with for a long time that are now sourcing those transactions. And I still share in that excitement, but I'm not exactly on the front lines anymore. And so I think that's been the hardest is, kind of leaving that a little bit behind. But at the same time, hopefully it comes through. I'm very passionate about what we do. So I do love sharing, what we do and our strategy with investors and talking to them. So it's just taking that sort of energy and passion that was directed towards operators and principals and brokers to source deals to investors of this is why you want to invest in these product types. This is the strategies that make sense. These are the places that make sense. Here are the people that you want to back and all of that.
CenterSquare's got a global presence and footprint. Can you just share where some of your, I know you're HQ'd in Philadelphia, but where are some of your other global offices domiciled based? And just give us a kind of a flavor for kind of the firm-wide AUM as well.
Yeah, domestically, so as you mentioned, we're headquartered in Philadelphia. I'm in our Southern California office, so Newport Beach, south of LA. And then we have offices in New York as well. And then globally, we are in London and Singapore. And total as a firm, we have roughly 15 billion in assets under management. It depends at what point in time because the listed securities will fluctuate.
Yeah, I can imagine. And how is that roughly split across the kind of four strategies?
I don't have the exact splits, but very roughly, the majority is definitely the listed security side. And then it's pretty equal between private equity and private debt. And strategic capital, I kind of would still lump into private equity. So it's probably a little bit larger than private debt right now.
If you kind of take a little bit of a step back, what's your kind of view on the domestic, and by domestic I mean kind of US market? What are some of the challenges and where do you kind of see the opportunity as well?
Yeah, challenges are always going to be, that uncertainty. There's been, I've been doing this for a long time. I've never been in an environment where you've just had, what are the rules of the game? Like that's probably the biggest, challenge. We've gone through the other large challenge, right? We went through the repricing already. We got through COVID. I mean, the last 5 years have been challenging, right? You had a global pandemic, and then late 22 into 23, the beginning of the fastest and steepest rise of interest rates in 40 years. Those are two large events to get through. But where we are now and what I see the opportunity for real estate, commercial real estate's already gone through that pricing. Like we had that correction, overall, pricing is down over 20%. So I like that. Like, I feel like you can see the bottom. We've gone through that. You're not going to be catching a falling knife. So we have a good foundation to work from, to enter. In terms of the opportunity, okay, well, now you can buy high quality assets in the sectors that you like. So for us, that's residential and industrial, and the essential service retail at reset pricing. So you can get in at a great basis. Your net operating incomes have been reduced, because of the kind of correction in the market and specifically supply. At the same time, so for rental housing, you had some oversupply. When interest rates were as low as they were and it was such a hot sector, the developers just they develop. That's what they're going to do with those ingredients. So we got oversupply, particularly in Sun Belt markets. So the NOIs are depressed there. Industrial, there's really more big bucks that got over delivered, and we kind of stayed away from that. But there's still been some supply challenges there as well, except for the really small stuff, which is why we play there. But that's the opportunity. You can buy good, high quality at a reset basis, right? I always say, and I preach this to the folks, the next generation is, we sit here all this time with our financial models and looking at cap rates and how they're tied to interest rates. All those things are pretty fluid, and then they're going to change. What doesn't change is the real estate, right? Coming back to it's tangible, it's physical. Get the real estate right, get the basis right, because when you make that acquisition, your basis that's forever.
As in, like you make your money on the way in.
Yeah, on the buy the right real estate at the right basis. So. And then I would say lastly too, sale discipline. Like that's, I've been through a few cycles where folks, maybe they got those first two things right, but then they say, oh, I'm going to be greedy. I want to hold something a little bit longer. I see a little bit more value. And then, the market will change. The global financial crisis will hit, COVID will hit, interest rates will change. So, sale discipline is important. You also can make your money on the exit. If you've created value and someone will pay you for the ability to create additional value in their minds, and you can deliver a return to your investors that's in line with what you have, told them you were going to deliver. Sale discipline. Take it, deliver the money to your investors. They won't be mine. Maybe you could have gotten the extra, 300 basis points of return by holding it. But if you've delivered the return to investors and de-risked any future downside, that's a good way to do it.
Running kind of a fund series must be hard in one sense, because you're trying to exit a fund at a moment in time where maybe the market is slightly depressed, whereas actually you've raised a load of money for your next fund and it's a great buying window. How do you deal with that kind of dichotomy in terms of fund performance and track record versus, it's now a great buying window, and maybe LPs are kind of waiting for a return of that capital to then recycle and give you to your next fund or your next commitment?
Yeah, that's a great question. I think we've been fortunate. So it starts on the portfolio construction. The sort of assets you buy, are they going to be resilient? Are they going to be able to get through, challenges? And so certainly, Fund 5 has been fully invested. We were fortunate in terms of when everyone was buying, sub 4 cap rates for industrial and rental housing. We weren't. We were buying actually vacancy, good quality product at a basis with a real, value creation plan. And we didn't have to assume that cap rates would stay low forever, because again, we've been through a few cycles. We knew that was the anomaly, and you didn't have to assume just rapid rent growth. It was things that we could create. We had a good path to creating that NOI. So I think that's served us well. We've been able to be resilient. So some things like lease up plays in the rental housing space. Yeah, so it's not a great time to sell, but the rationale is we know why, because there's all the supply. So now we can see that the supply is coming down and we're getting pricing power again. So yeah, we'll hold those a little bit longer until it's the right time to sell. And if we don't see a path to growth, we've executed our business plans. We're not going to sit around and say, okay, well, maybe exit caps will drop and we can do better. You're balancing that while holding, obviously drags on your IRR, but maybe you could get a better multiple in certain product types. So we're always trying to balance that. And the way we do it, candidly, is we've got this, proprietary analysis, and you just need to keep it down to the data. And we call it an A to C analysis. So we're just pretty much every day that you're holding you're buying it again. So we're constantly looking forward at that analysis. And that's just what you have to do. You can't say, I bought this. This is my business plan. Let's laminate that pro forma, put it on a bookshelf somewhere, and it's just going to keep going. The industry is dynamic. You need to constantly be evaluating, be active. And one of the things that we did in our fourth value add fund, and this is probably a good example to your question, it's 2019 vintage fund, right? So we're investing, executing business plans, and then trying to harvest through those 2 points that we just discussed. Global pandemic, fastest, steepest rise in interest rates. And by just being disciplined, having the process on what we wanted to buy, and then knowing that, okay, we think at this time we could see a path. There's a risk that interest rates are going to rise. That's why we pivoted to where we pivoted. So turn around and sell as soon as you can. So in that vehicle, we stopped investing in multifamily in the fourth quarter of 2019. Not because we didn't, we saw all the supply coming down, and not because we didn't like the fundamentals. We didn't like the valuation. Coming back to my basis comment, cap rates were really low, and everyone was underwriting this, strong rent growth and exit caps being, still in the fours instead of the historical averages, and it meant people were buying it at or above replacement cost, and that just didn't feel comfortable to us. So we stopped buying, and then fast forward to we did have some things in our portfolio. COVID hit the next quarter in 2020, so we stopped any renovations. Right, we had a business plan to renovate units and create NOI. Stopped. Let's just keep it full. 21, COVID, post-COVID, all of a sudden interest rates took off. Growth took off, right? Rent growth. Because we had the right product. Again, the theme was we want to be in the suburbs. There's an affordability gap. People can't buy homes, but they still want to be in the suburbs with the right school districts. And so that benefited, during the COVID period, strong rent growth. And then 2022 came along, and I'm like, this is great. All right, team. The opportunity, the NOI is now almost where we underwrote without us doing renovation. Now we can renovate and just hit it out of the park, which then leads to another really huge competitive advantage of the CenterSquare platform, the private and public interaction. So we have biweekly calls, and we're on these calls, and the gentleman who's the portfolio manager for multifamily listed securities, the REITs, he says, "Hey, Jeff, I know we all know what's going on with 10-year treasuries here in early 22. It's starting to increase, and we can kind of see the path and the trajectory." Then he layers on in real time in front of the whole team this chart. Here's what's happening with multifamily cap rates. And you can see those also increasing, following the same path. You take that trajectory, and it's like, okay, well, that's a great leading indicator. Multifamily cap rates are going to expand. This is kind of what we expect. This is what we were preparing for and why we stopped investing. All right, team, let's go underwrite all of our multifamily deals, do the renovations, but let's stress test exit caps, right? Have that financial discipline. And you could quickly see that that was going to wipe out your value. So directed the team to sell every multifamily asset in Fund 4 by the end of the year, 2022, which we did. Locked in kind of backwards looking pricing for folks who didn't have that informational advantage that we did. And that completely that was a huge impact on the positive performance. We delivered returns near the high end of our range and returned capital to investors. So, coming back to your point, that's what investors want.
Yeah,
right?
one of the benefits of having that kind of listed and direct private piece and that cross collaboration across the teams and that firm-wide view and this forward-looking indicators. One of the things you kind of touched on is data. Data is a big word right now. AI, technology, a lot of leaders are looking at their business, trying to work out where does AI, technology, system, process fit in. We've touched a little bit about your kind of process and system and the repeatability of that. Where does kind of data, AI fit into this CenterSquare kind of business? And how do you see that impacting your ability to kind of generate alpha and outperformance?
Yeah, it just, the ability to, how we're using it right now, near term, we've got an AI lab, our whole team that's really focused on it and looking at what sort of tools and how can we use it to improve, our business. I would say that the near term, like right now, what we can use it for is just the ability to efficiently synthesize large amounts of data, right? We harvest a lot of data, between our operations on the private side, on the REIT team. So how do we, instead of having a bunch of analysts having to manually go through everything and put things in Excel spreadsheets, how do we synthesize all that to be able to see trends and in terms of our operations, key performance indicators, so that we can make decisions and kind of say what are some correlations between what this data that we're seeing. So helping us make decisions by synthesizing large amounts of data is really important. And then there's just things like efficiency. I mean, as part of due diligence, we go through all these leases, et cetera. And so instead of having to manually go through the leases, you can run these things through AI and you fill in here the information that we need to abstract, and it can do all that for us. So it just makes it more efficient. And so then our team can be more focused on, executing the business plans, driving value for our investors instead of doing, manual tasks that are necessary, but aren't necessarily always as creative.
Yeah, not as high value.
Right.
You've been on the road, as I said at the top of this conversation, London, Amsterdam, Stockholm, but you're also very well placed in terms of talking to capital from the US. Yeah. Trump, it's hard to kind of ignore, the impact that he's having, general world order is shifting, the sense from the conversation that I'm having is it's a bit more of an American first world. And that's having an impact in terms of maybe inward investment from American or North American US capital. They're looking to maybe diversify, capital to Europe. What's your take from a capital markets perspective, from an American LP perspective, from the conversation you're having? And then the second part of the question is, you've been on the road across Europe. What's the sense from the European LP base in terms of wanting to get access to the US market?
Yeah, look, it comes back to that, I'll say, certainty word, right? Like earlier in the year, especially starting in April, there was just a lot of uncertainty. No one really knew the rules of the game, and really just talking about tariffs and et cetera. And so at the end of the day, though, U.S. investors, our perspective is we got to focus on real estate's long term. You got to think long term. Good thing about the U.S. is we have elections and things change, et cetera, and you can only have so many terms as a president, et cetera. So, and I think people are starting to realize that there's a lot of talk, but it might not be as bad. Things don't always end up. It's still kind of shifting. So I think folks are feeling comfortable that, all right, it's not perfect clarity, but from a commercial real estate perspective, again, there's a good entry point. We're gonna. I think the logical, consensus view that and the perspective you have to have right now is, okay, GDP growth might be slower. It's not going to, blow it out of the park right now, and there's going to be some inflation risk you got to keep your eye on in the labor market, employment. But there's still opportunities to get in, and so you're not going to have maybe that V-shaped recovery. But as an entry point, again, if you're thinking that long-term perspective, fundamentals are still generally strong. That supply is starting to diminish. One of the other strengths in terms of the opportunity set is forward supply. Because of interest rates and maybe some uncertainty on development, it's a lot harder. So you don't have a lot of new product coming. So that will restore pricing power to owners of current assets that are buying today. So that's kind of the underlying opportunity set. But it just comes down to growth opportunity. I mean, the U.S. is a large liquid market, and liquidity and growth market. I would say the tone has changed from when I was talking to investors, both domestic and Europe, from April through kind of earlier in the summer, where it was, what is going on? This is, I don't really want to touch the United States, et cetera. I need to focus on my home market for the European investors. And the more recent, the last two, because I was out here in September as well, I think that's thawing. I think global investors are still realizing, okay, when it just comes down to growth, the U.S. is a growth market. It's liquid. We can't ignore it. And okay, now that we've seen how things have played out since all of the talk, et cetera, earlier, right, it's not all going to come to fruition. There's been some news still challenging kind of the legality of tariffs, et cetera. So investors are realizing, okay, long-term perspective, fundamentals are pretty good. It's a good entry point. It's a tangible asset. I can get cash flow, I can get appreciation. And then, you have to just look at the equity markets today, again, more holistically for investors who are looking at everything beyond just real estate and saying, okay, are we a little bit toppy? Everyone's leaning into some, a small handful of stocks are really driving the stock market. So I think folks are thinking like,
the last couple of months have been mad.
Yes.
In terms of the growth there.
Yeah.
And so what the kind of the weighting effect in terms of portfolios and how they're structured, is that kind of what you're alluding to in terms of like over allocation to one sector versus another?
Yeah, a little bit. And upside versus downside, right? I mean, okay, if you're looking at valuations, in the traditional equity markets, where they've gone, is there how much more growth, or is there more risk that there's going to be a correction versus, okay, commercial real estate's gone through its correction. There should be some upside. Now, it's not going to be the explosive, AI-driven or technology-driven type of growth, but it's going to be steady growth with income appreciation, and there's value to having that in a portfolio. And I think folks realize that, all right, if I can get in now, I mean, history shows, if you look at the data, after major dislocation events, investors who come in just from a vintage perspective, in the first couple of years after these events, before there is perfect clarity, right? It's those will outperform because once that green light's on, the capital comes in. So the cycle, as I view it, it's the C's, right? Okay, certainty. You need some certainty first. But once you have a little bit of certainty, that leads to conviction, from investors, which then leads to the capital coming in. And that's a big thing that I'm seeing over the last 2 months, both domestic and global. Investors are picking up their pencils again. They're looking and saying, okay, I've gotten through my priorities in 2025. Maybe it was private debt, infrastructure, data centers were huge. I've made my allocations. Wow, real estate is looking really attractive, particularly value add. If I'm going to be in a slow growth environment, higher interest rate for longer environment, well, I'm not going to create value by just having outsized market rent growth or cap rate compression. That was last cycle's game, right? That I need to come down to asset selection. It's good old fashioned real estate. I need to pick the right assets. I need to add value to be able to generate, grow NOI to be able to generate returns. and active management, like we were talking about. I can't just set and forget. I need to constantly be managing my asset. So that capital is starting to see all of that. They come in, and what does that do? That creates competition. Everyone's now starting to compete again, which then leads to compression. That's sort of the cycle. And right now we're in that that mid phase where people are having a little bit more conviction and certainty that now's the time to come in. I think capital's picking up its pencils and pretty excited about next year that, more, but I don't think it'll come rushing in, which is great for, again, those who do have the conviction and capital to invest now to get ahead of before that green light comes on and, the horses are let out of the gate.
So just run me through. Is there 5 C's? And what are they?
It was certainty, conviction, capital, competition, compression.
And then the 3 A's are?
Asset selection, adding value, and active management.
Love a framework. Love a framework. And I'm sure the people listening to this as well will be writing that down furiously. We touched on earlier in our conversation the kind of the London team and platform. Can you just provide me with a little bit more colour in terms of the office here and what it does?
Yeah, we've had a team here since either late 08, early 09. Planted in London, listed securities focused. But it's been great because we've had folks on the ground, so we get information here. And then about 3.5 years ago, Steve Carroll joined the team to open up the kind of capital markets experience, much more investor focused. And that's just been tremendous because it's, again, having someone here, direct relationships. CenterSquare is pretty well known in the United States. We've got a good roster of investors. We do have some large global investors as well, particularly on our listed security side. So Steve and Tanya's on the team as well in terms of developing those relationships, educating the market about what we're doing in the States from the private side as well, and just trying to, again, be the holistic platform. We can offer private equity, private debt, listed securities, lots of ways to access real estate, strategic capital, and just educating the market. And it's been great. Again, I've been with the company for a long time, and over the last 18 months, I've been making multiple trips to Europe and getting more exposure to the investors here and educating them about what we're doing. And it's great. We live in a global economy, and folks should be more interconnected.
There's a bit of news that came out recently around Aligned Data Centers. What can you share about that particular transaction, that deal, and that win for the business and your investors? Yeah,
it was a great win for our investors. That was in our strategic capital platform. And again, just demonstrates that link of being both public and private. We had a lot of information in one of our thematics of what was going on with data centers and some of our relationships. And having exposure in the public space, so we were able to back a very strong management team that had great operational expertise. And then we talked earlier about kind of sale discipline being key within our value add fund. It's really the key in everything in real estate. If you see something and you kind of look at the value proposition that someone's willing to pay you versus your view of potential upside versus downside risks, and that's across all of any of our strategies. You exit and return money to your investors. And we had the opportunity with Aligned. We believe in the company and the future growth, but there was a buyer who was willing to come in at a price that when we run our analysis, we said, okay, we're willing to take our chips off the table, deliver great returns to our investors, and it was a successful investment.
You've had a phenomenal career. You've raised a bucket load of capital, done a load of deals. Maybe a next gen leader who's a little bit earlier on in the journey. What advice would you give to them listening to this, kind of navigating all the headwinds and the challenges, but also the significant opportunity in the market?
Yeah. The folks that I work with, they know I hammer this point home a lot, but get your face out of the computer in the Excel model. That's not how it's not the sole decision-making process, right? Just as things became more financially sophisticated, I'll call it a little bit of the Wall Streetification of real estate. And we saw this a lot in the last cycle. Just everyone's making decisions based on what they're inputting into an Excel model. And circling back to the beginning of this conversation, real estate's a tangible asset. It's real. It's in the name, real estate. Bricks and sticks. And one asset on one corner of a street versus another could perform completely differently. So it's get out from behind the desk, go see the real estate, and understand the market, understand the drivers. Make sure it's not commodity. Why do you have any kind of pricing power? Why does a tenant want to be in this building versus another? And you need to be in those markets, and then I add on top of that, it's also, so not only do you have to focus on the actual property and the places that it's in, but the people, right? Go network. You need to make smart decisions. You need to have a good network of people with different opinions. Don't think you know it all. Be humble. Ask a lot of questions. Have high intellectual curiosity, and talk to the local brokers who are in the market. Everything from leasing to property managers to walk around. If you're touring a property, like a retail property, for example, talk to the tenants, talk to the customers in the stores, get a feel for it. One of my favorite things in the service industrial space, all these small business owners just learning, why are you here? Like what drives your business? Why do you need to be in this location? So nothing beats, that's what I love about the business. It's the financial component is important. You need to be financially savvy and understand that. But to make really decisions and drive performance, you need to be out there at the properties, talking to the people.
Well, in a world of that's increasingly going to be dominated by AI and technology, I guess the beauty of being in the real estate game is, as you said, it's real, it's people centric, and it's all around where people, I guess, work, play, do business, and live. And AI. God help us if it does, but it's not going to be able to, replace that kind of human interaction and that trust and, that kind of input from actually talking to people and gathering that intangible qualitative information. The question I ask everyone who comes on the podcast is, if I was a global allocator of capital and I had £500 million to allocate to real estate, who are the people, what property, and which place would you look to allocate that capital?
Yeah, I mean, in terms of people, I would say I want to invest in the small business owners, the entrepreneurs, the hardworking people that have grit and are, running their own businesses, which then leads to, the places. Well, okay, I mean, as you've probably picked up from things that I've talked about, this service industrial space that we're active in, all these small business owners, plumbers, electricians, contractors, like the heart of a community in the retail space, a lot of these local shops that this is their lifeblood, their blood, sweat, and tears into these businesses. And we've seen how it's performed during downturns. They're going to do whatever they can to keep their businesses. This is their livelihoods. And so, those are the kind of the people and the, sort of places that I want to invest in. It's the heart, the lifeblood of a community. So, again, in terms of specific locations, it's going to be in that heart of a community where you've got, density, good amount of population, some growth, and those, peoples and shops and businesses are interconnected, right into the fabric of a community. They become essential. They become mission critical to that community. In any time of market, where there's any kind of change and dislocation, that essential kind of mission critical need is very defensive. You're going to be able to keep your properties full. The businesses are going to keep running. And it's sort of, certainly in the States, it's a, there's an entrepreneurial culture. And so if a tenant doesn't work out, you lose a tenant, there's always someone who wants to be in that community and providing services to that community. So that's just, sort of how I view it. And again, with 500 million pounds or dollars, that's a good amount of capital to invest in these small buildings. So I would definitely do it in both. So it's like the essential service retail and that service industrial.
It's like what, like car mechanics, it's plumbers, it's electricians, it's tradespeople.
Exactly.
It's those smaller, mom and pop type businesses that are essential, where you can really partner with your occupier to drive value and improve their business, and in turn doing so, appreciation, income, and overall total returns.
Yeah, that's great. I like that you use that word partner as well, because that is a little bit different in these sorts of properties and communities. Is that one tenant, they want to find another. It is a community. They want to have their neighbors who they share these truck courts with and are right next to, be like-minded or complementary businesses. And they'll bring other businesses. Hey, I'm, doing marble and stone. I want to be next to my guy who does all the woodworking because we're going to work on all these projects together. And you do see that. Same thing with retail. You want that complementary tenant mix, and good quality tenants. And just having a role of, beyond just being the investor, but having a role of, helping create that sort of micro community at the property, which then, is impactful and benefits the surrounding community. There's a lot of things I love about this business, obviously delivering returns and results for our investors. But as we've talked about, it still comes back to also the people, having an impact on how you can improve a community by maybe you're just cleaning some things up. Your capital is not only going to deliver a return to investors, but you're going to improve a micro community at a property, which is going to then help improve and contribute to a broader community that you're investing in.
Jeff, absolutely love the energy, love the insights, love the lessons, the views and opinions. Feel really grateful that you've been able to swing by the studio today here in central London to share a little bit about your background journey and the CenterSquare business. I'm really excited to see what you and the broader team go on to achieve through the end of 2025, 26 and beyond. I'll for sure be watching from the sidelines as you attack the market and take advantage of the opportunities and all the different strategies that CenterSquare can. So thank you so much.
Thank you, Matthew. It's been an honor and a privilege to be here. Thank you.
Hey, quick one from me. If you enjoyed this conversation, do me a favor and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.